Hi everyone, I'm back again for another Working Together. This time we're moving into the section 1-3 or Working Together papers. I have on my screen, I'm logged into MindTap. You should know how to get in there now pretty comfortably, and hopefully you're figuring out how to run the different things across here and what's going on. But let's go ahead and get started. We're going to do Working Together Working Papers 1-3. Let me get that right. So let me click on that, and it's loading as we speak now. And of course this will change here, so we can go back up to the chapters. Remember, we're still in chapter 1, and it's Working Together 1-3. So the end of the lesson type stuff. And here's the information there. And our accounting equation is still there. Assets equal liabilities plus owner's equity. This part you're going to do together. So let me click and open this up so we can do this together as a class. So for each transaction, determine the two accounts in the accounting equation that are changed. Decide whether each account is increased or decreased. Enter a plus in the column if the account is increased, and enter a minus in the column of the account is decreased. Both a plus and minus sign can be entered if necessary. So the same transactions are over here. These are anything that affect that. Notice that my accounting equation broke it down by account. So I have cash, accounts receivable, which is a customer that owes you money, and then supplies and prepaid insurance. All of those are considered assets. Okay, and then a new terminology we added is accounts payable, but in this case it's accounts payable hyphen Corna supplies, which is a liability, and that's a vendor that we actually buy supplies from and charge it and then have it delivered. And then the owner of the business with is Nathaniel Conrad Capital. So that's a new term added to it. So it kind of breaks it down into accounts. So it makes it easier to understand. But the very first transaction on here, it says receive cash from sales. Well, sales is a good thing. So that's an increase to the asset cash. And that also increased owner's equity or the capital account. So we're going to put a plus in cash, which is an asset, and a plus in Nathaniel's capital, which is owner's equity. That's an increase. Sold services on to Hammond Company. Well, Hammond Company is a very valued customer, so we'll let them charge things with us because they know they're going to pay us in the future sometime. So that's accounts receivable. So that's a plus, which is an asset. They owe us money, and they'll pay eventually, probably in 30 days, but they owe us money. But my owner's equity also increases, or the capital account increases. So now I'm on number 3, paid cash for a cell phone bill. That's just kind of the cost of doing business. So cash would decrease because I paid cash. A cell phone bill is an expense, and so that would actually decrease the capital. But it's kind of the cost of doing business. So the next account is receive cash on account from Hammond Company. Well, they paid us, so that increases our cash, which is an asset, and it decreases their accounts receivable, so they owe us less money. The owner withdrew equity in the form of cash. So an owner can do two things. In the last exercise 1-2, we learned that the owner invested in the business, and so the only other thing the owner can do is withdraw from the business. He can't give himself a paycheck because he owns it. So if he took cash, that's a decrease, and it also decreases owner's equity on there. And so that's Working Papers 1-2. Some key terms you should know. We should make sure you know that. Revenue is one of those. Another one is sell on account. And the third one is expense and withdrawal. So an owner can withdraw supplies or cash from a business. Expenses are what you pay for the business. And sales is when you make a sell and it helps your account. And the last one is revenue. When we make a sell, we add revenue, which increases owner's equity, and it's a good thing. So good luck on working on your own. See you in class and enjoy.